All right, let's get right into the belly of the beast, the bad debt trap. This is the kind of debt that eats your future. It's poison. The definition is simple. You borrow money to buy something that either loses value, what we call a depreciating asset, or worse, something that's consumed instantly, like a vacation or a fancy dinner. You are literally paying interest to own a melting ice sculpture. The most common and the most devastating example, the car loan illusion. We all know that feeling. The new car smell, the shiny paint, that feeling of success as you drive it off the lot. But here's what's actually happening. That asset loses about 20% in its first year. Within 5 years, 60% of the money you paid is just gone. And here's the punch to the gut. The average new car payment in America has skyrocketed past $730 a month. And the average loan term? 72 months. That is 6 years. Let that sink in. You are committing to a $730 monthly bill for 6 years to finance something that is guaranteed to be worth less every single day. It's a treadmill running in reverse, and you're paying for the privilege. But you know what's even more vicious? The credit card compounding trap. This one is a silent killer. We swipe for gas, for groceries, for that Amazon purchase we need. But the average credit card APR for accounts that actually carry a balance is now over 21%. Do you understand what that number means? That's not an interest rate, that's a prison sentence. Look at the math. If you carry a $5,000 balance, maybe from one tough month or a single vacation, and you only pay the minimums, you're not in a puddle, you're in quicksand. It could take you 15 to 20 years to pay it off. And in the end, you'll pay more in interest than the original $5,000 you spent. And we all love to talk about compound interest, how our investments grow. This is negative compounding. This is your debt making more debt, all by itself, while you sleep. And just when you think the hole can't get any deeper, there's one last twist of the knife. This is the little-known fact that makes this trap so effective. That $730 car payment, that 21% interest on your Visa, for the average American, none of that interest is tax deductible. You see, the system might give you a break on a mortgage, but on your consumer debt, zero. You are paying the highest, most aggressive interest rates on the planet with your post-tax dollars. You earn $100, the government takes its cut, and then from what's left, you pay the banks 21%. This is the cycle that keeps people stuck. It's financing a lifestyle today by selling your freedom tomorrow. But what if you could reverse it? What if you could use debt, not as an anchor, but as a lever? That is exactly what good debt is, and it's the single biggest difference between those who build wealth and those who just, well, stay afloat. We're breaking down how that works in the very next section. So, if bad debt is the anchor, good debt is the rocket. This is the mindset shift that changes everything. The core premise is the exact opposite of the trap we just talked about. With good debt, you are borrowing money, we call this leverage, to buy an asset that is expected to appreciate in value or, even better, generate income for you. The asset itself pays for the debt. You are taking on a liability to acquire an asset. Let me show you the power of leverage with the most classic example, real estate. Imagine you have $100,000 in cash. Path 1, no debt. You play it safe. You buy one $100,000 rental property with cash. The property appreciates by 5% in a year. You just made $5,000. Your return on your $100,000 investment is 5%. Not bad, but it's slow. Path 2, the good debt mindset. You take that same $100,000 and use it as a 20% down payment on 5 $100,000 properties. You now control a $500,000 portfolio. Now let's say that entire portfolio appreciates by 5%. What's 5% of 500,000? That is $25,000. Your return on your original $100,000 cash is now 25%. That is leverage. You use the bank's money to amplify your gains fivefold, and that's not even counting the cash flow from rent, which is paying down those mortgages for you. And this isn't just for real estate. Look at the business multiplier. A smart business owner takes out an SBA loan at 9% interest. Is this bad debt? No, because they use it to buy a new machine. This machine isn't a depreciating liability, it's a workhorse.
That machine increases their production and generates a 25% return for the company. So let's do the math. They gain 25% and they pay 9% for the money. That 16% spread is pure profit, created entirely with the bank's money. But you might be thinking, okay, great, but how do I get the cash for that first down payment? This is the strategy I call the asset launcher. Many investors use a home equity line of credit, a HELOC, on their own home. They tap into that dormant equity that's just sitting there, doing nothing. They pull that cash out and use it as a down payment on their first rental property. Think about what they just did. They turned their primary residence, which is kind of a hybrid asset, into a launch pad for a true cash-flowing machine that someone else, the tenant, is now paying for. See the pattern? Bad debt costs you, good debt makes you. But this brings us to the most dangerous part of this conversation. What about the in-between, the debts that look good but are actually traps in disguise? That's the gray area, and we're tackling that next. So let's put a price tag on this. This is the $1 million calculation. Scenario A, you take that average $730 per month for car payment for 6 years. You pay over $52,000 for an asset that's now worth a fraction of that, a guaranteed loss. Scenario B, you invest that same $730 a month into an S&P 500 index fund. At a 10% average return, after 30 years, you'd have $1,482,855. That's not a typo. The simple choice to finance a new car is a $1.4 million decision. That is the true cost of bad debt, the opportunity. The wealthy understand this. They master good debt. You've heard millionaires keep mortgages they could easily pay off. It's arbitrage. Why pay off a 5% loan when you're confident you can earn 10% in the market? They use the bank's cheap money to make more money. But the ultra-wealthy have a playbook on another level. It's called buy, borrow, die. 1. Buy. They buy appreciating assets, stocks, real estate, and never sell. 2. Borrow. When they need cash, they don't sell and trigger capital gains taxes. They just take a tax-free loan against their portfolio. 3. Die. When they pass away, their heirs inherit the assets. A tax rule called the stepped-up basis legally erases all the capital gains. The heirs can sell a small portion, pay back the loan, and owe zero tax. That is the power of understanding the debt system. But look, these are advanced strategies. For most of us, the real danger is in the gray area. These are the debts that sound smart, the ones that feel like an investment, but can be just as deadly as a credit card. And that's exactly what we need to break down right now.